Hey everybody, this is Jose here. We are about to start the session. This is a sound check. Let's use the following few seconds for a sound check. Please go ahead and confirm that you hear my voice properly, and that way I know we are ready to go. That's it. We just reached the top of the hour, so I'm just gonna maximize the introduction slide. Very good, wonderful. I can see your confirmations. How are you, Charles, Mark? Everybody good? Good to see you all. So we are now about to start. 1 second. 1 second here. And here we go. So we are ready to go. How are you, everybody? Good to see you, my friends. Happy Sunday. Today is 16th of March 2020, and we are getting together here to sharpen our skills. So sharpening session today. And we got a couple of things to do today. We're gonna have a pretty important question that was sent by one of the students. Many times the questions that you guys send are easy to answer in an email. Sometimes they're not so easy and they require a bit more demonstration or time. And today I want to take one of those questions to our session so we can talk about it all together. And then the second part of the session is going to be looking at the current market condition, looking at investment opportunities. The other day we talked about combination of option strategies in order to position certain option trades that could be good for long-term investors. Okay, so we'll take a look at that, and that's the plan. Okay, before we start, we have a disclaimer, so I'll do that and we go. Disclaimers: the following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive by using our products. And that's the disclaimer. So the session is now officially introduced. Okay, so time to begin. Okay, so I have TradeStation here. There are a few more things I got ready. I also have a TradingView. I also have a list of timeframes to be used. Okay, and as I said, today I would like to start the session with a question, which is the one that you can see here in the middle of the screen. Let me make this a little larger. I think that will be convenient to make it just a little larger so everybody can read easily. Okay, so the question here was the following. Okay, so Jose, I was going over the 6th of March recording. That was a get-together session, and you used range instead of edge timeframes to enter the trade. I didn't quite get that. When would you use the range? Okay, and to be honest, this is something that we have addressed in the past. Okay, but it's a long time ago. And therefore, in order for you guys to be able to understand this properly, I will need to send you back in time many sessions ago, and I think it's better that we have a fresh conversation about it, so it's all fresh in your minds. Okay, so let me see. Oh, fantastic, Roy! I can see you are here with us. Pansy, how are you? Leland, nice to see you. Very nice. So let's talk about this. Okay, so if I show you this screenshot, for example, which is a collection of our timeframes. Okay, notice that in the methodology that we employ, we are using a time frame that we call common, we're using another time frame that we call edge, and we are using another time frame which is optional that we call the reactive time frame. Okay, now for the common time frame, since the common time frame, as the name suggests, is common, so we use the daily, the weekly, the monthly. If you are doing short-term trading, so instead of daily, weekly, and monthly, it's gonna be let me zoom in. It's going to be common 15, common 60, common 240. So depending on the markets that you trade and how active you want to be, you will use lower time frame as low as the 15, or larger time frame as large as daily, weekly, monthly. Okay, so you can go as high or low as you want with the common time frames, and this is just to understand the climate, understand if it's time to trade or not, understand which is the likely direction in which the market will continue moving, and have a higher quality opportunity based on those parameters. Okay, but again, for the common time frames, there is not much to discuss when it comes to the time frames because they are common. That's why we call it common time frame. So it's not a big deal. Now with the edge time frames and reactive, there we get a bit more specific, isn't it? We got to be more specific, and I would like to start looking at edge time frames with the futures markets. Okay, so these are the edge timeframes that we use when we trade futures. For example, let's say you are a trader using the 15-minute time frame with the S&P 500 futures. Okay, well, if you were to do that, your edge timeframes would be the 2-minute time frame, which that one is based on minutes, but you will also use a share bar, which is 2584, and a tick chart, which is 1597. Okay. This is what you would use. And if it was to be the NASDAQ, because liquidity parameters are different, so you will end up having different figures. But my point is that with the futures markets, and by the way, the reason why what I'm about to say is like that is because futures markets are centralized. Okay. So with the futures markets being centralized, apart from the time frame for edge applications, you use shares and ticks, which are fantastic timeframes available with centralized products such as stocks or futures. Okay, but what happens when you trade forex or CFDs or cryptocurrencies, which are products that are not centralized? Okay, what happened at the moment in time where then you cannot use share timeframes or tick timeframes because they don't exist. I mean, and certainly some forex brokers, for example, they may tell you, yes, we have volume charts, we have volume information, but that volume information only applies to them as a company, as a broker, and therefore the trades that are executed among that particular one company, which is very small compared to the overall size of the whole forex market as a whole. Therefore, with forex brokers, basically, probably the safest bet is to stick with time frames based on time, and that's it. Okay, but again, the name edge suggests what the word edge means, isn't it? And in this sense, we always like to pick up a little bit extra precision, a little bit extra insight from when it comes to what's going on in the marketplace and what are the highest quality pile of orders in the market and so on. And therefore, an alternative approach to when there are no shared timeframes and tick timeframes available is to use range timeframes combined with minute timeframes. For example, in this case, if your common time frame is daily, then the normal natural edge time frame would be 55 minutes. Okay. Well, together with using the 55-minute time frame, you can also use the 55 range time frame. And this would be kind of a little bit of an X-ray of the 55 and give you a little bit of an extra insight. Is it going to be the best time frame in the world? No. Is it going to be that precise and perfect given the fact that Forex and CFDs are not a centralized product? No. Is it going to give you a little bit more visibility compared to only minute timeframes? Yes. So is it worth it to use? Yes and no. It depends on how perfectionist you want to be. So initially, it's not needed for you to use range timeframes. Using minute timeframes will be good enough. But if you happen to be a trader who is very perfectionist, you happen to be a trader that don't mind to spend a few more minutes every time you plan a trade, okay, then combining range and minutes would be the best way to go. Now, in all sessions that I have been running here on the YouTube channel, okay, instead of using this setup with TradingView, I have been using another setup. Okay, let me load the setup that you may have seen in prior sessions. Okay, for example, this one here. So many times I have used setups such as this one, where in one of the charts I got the 240-minute time frame, and that is being used for climate analysis, as you can see here on the bottom part of the screen, isn't it? So you have your climate. Then I got the 21-minute time frame, so 240 minutes combined with 21. Okay, this is the classical time frames that we use in Forex, isn't it? Let me bring another screenshot here. Okay, that one is the classical for Forex. Okay, and by the way, all of you should have these screenshots, and if you don't have them, send an email and we'll send it to you. Okay, by the way, we are a little delayed with emails. Okay, so we are aware of that. So if you have sent an email to us recently, just bear with us. We'll be back very, very soon. Okay, back to you very soon. So let's say you're using the 240-minute time frame, like I have right now on TradingView. You can be using the 21-minute time frame for your edge time frame, but you can also be using the 21 range time frame. Okay, so if you look at this one here, okay, so you got the 240-minute time frame combined with the 21-minute, but also the 21R, where the R stands for range. Okay, and now, for example, here, if you wanted to buy, well, actually, it's an opportunity to sell because the climate is red. Okay, but it's okay. Bear with me for a minute. So let's say you wanted to buy because you are inside of a green UFO, and you were to look at the range time frame, and the range time frame also has a UFO. Well, this would kind of increase your odds, but on top of that, maybe your location for the stop is somewhere below this UFO. Okay, but the range time frame tells you, you know what, it needs to be a little lower, and because of that, or maybe because of those. Okay, and looking at the 21-minute time frame combined with the 21R time frame, range time frame, gives you a little extra edge. It's a little bit like an X-ray of the 21 minute, and it makes a lot of sense, even though it consumes a little bit of time, and sometimes it's actually a little bit confusing, to be honest. Okay, so that's why in recent times, out of looking for balance between trade setups that are powerful enough and simplicity, I decided to work using this particular workspace, which is a bit simpler to utilize, okay? Because on the left, I got 60 and 8, okay? 60 and 8, which is one of the classical time frames, 60 and 8, isn't it? In the middle, I got 240 and 21, okay? So if I am very short term, I use 60 and 8. If I am intraday swing, then I use 240.21. And if I am more in the swing side and less in the intraday side, then I would be using the daily combined with the 55, which is the other set of time frames that you guys know are possible, isn't it? The daily combined with the 55. Okay, so that's why I kind of simplify my workspace. Okay, again, this is all about feedback from you guys, sending emails and so on, and based on the questions you ask, we understood that it was a bit confusing the way it was before. So this particular workspace with 4 charts, we basically gave up on him, and instead we're using this workspace, which seems to be more easily understood. Okay, now let's say I am planning a trade on the US dollar Swiss franc. Okay, and let's say that as I am planning this trade with the US dollar Swiss franc, I look at the climate suggests it's time to buy. I look at the EMA is 74. I go back to my 21-minute time frame, turn on the 21-minute time frame, and let me see if we have a UFO located at 94.61, which is below 74. Okay, but for simplicity, let's pretend that's good enough. Okay, let's pretend that the EMA is in the middle. In this case, the EMA is above. Okay, so it's not good enough. But let's pretend for simplicity in this example that is good enough. Okay, and we have a setup. So option number one, you use the 240-minute, you use the 21-minute. You have a plan, you have a setup that meets your rules. Take the trade. This is going to be your entry. Below is going to be your stop. Okay, and then you will use the 4-hour time frame to set the target, and that's your trade. That's it. Okay, but for the ones of you that are just a bit more perfectionist, then second step, you would come here to where the 21-minute time frame is on the top, where you have the UFOs, and now instead of utilizing 21 minutes, you would then move to 21 ranges. Okay, 21 ranges, and when you click that, the chart will update. Okay, and it should be quick. Okay, we can see the 3 dots flashing there, which means that data is being loaded. Here we go, data has been loaded. Okay, and what do you see now? Well, you now see new collections of UFOs at other price points. Okay, so you got 94.96, you got 94.92, you got 94.85, and you also got 94.72. Okay, 94.72. So in other words, you would make a note of those values, okay? And like, for example, this one, the bottom one is 69, correct? 94.69. So the bottom one is 69. And one thing you could do now is, knowing that you have a UFO, and that one is kind of overlapping the UFO from the other chart, from the 21 minute, isn't it? So you keep in mind 69, you keep in mind 72, and now when you go back to the 21-minute time frame, or in this case, the 69 happens to be above the 61, right? So you have 72 to 69 is right there, and this is kind of enveloping the EMA, because when the US dollar Swiss franc falls a little bit, the EMA will drop a little bit from 74 maybe to 72, something like that. So really, on the range time frame, there is a micro UFO right there, okay, which is not overlapping the UFO before. Sometimes they may overlap, and then you have to treat them like the one. You group them like that, like if it was a big one. Okay. Sometimes they will not overlap. Okay, and it's kind of like the situation right now, where you have one UFO somewhere here. Okay, one UFO somewhere here, and the other one below. Right. So you got more visibility. And the bottom UFO starting at 61, it's not enveloping the EMA, which is 74, but the UFO above is, and you will not find that UFO unless you had switched to the 21 range timeframes. So long story short, The range timeframes are optional. You don't have to use them, but if you choose to use them, it's certainly fine. It certainly adds a little bit of an edge, okay, a little bit of an extra level of visibility in the marketplace that will uncover UFOs that you were not aware existed. And certainly using it is recommended and would certainly produce a benefit. But there is also, like everything in life, pros and cons. And the downside here is that it takes more time for you to plan the trade. It may take a little bit more watching. It may widen the risk of the trade if you start grouping UFOs. You may end up with an overall distance from entry to stop, which is greater, and therefore you need to enter the trade with a lesser position size, and your safety target is further away. So you have pros and cons like everything in life. So bottom line, I would say probably what makes the most sense is if you look at yourself in the mirror and you happen to be a trader where you understand you are in the conservative side, in the perfectionist side, so then use time frame charts combined with range charts. If you happen to be a trader where you are more relaxed when it comes to risk and perfectionism, so then I would say 21 minutes is good enough, and you could just ignore the range timeframes because they are optional. Even though they provide a benefit, it's minor if you wish, and therefore not using them would still be okay. Okay, so basically it's all about user preference in this case. And the reason why in this case I'm not having a very strong rule about it is because we are dealing with a decentralized market, which is forex in this case, or CFDs. And actually, I mean, you've seen it, right? So if instead of the euro US dollar, okay, where sorry, the US dollar Swiss franc, where I got the UFOs at 95.18, now I was to load the same market, US dollar Swiss franc, okay, but instead of using FXCM, I was to use for example, Saxo Bank. Okay, so what's going to happen now? Well, now my UFOs are in a totally different location. Actually, now I am already inside of a UFO where earlier I was not. So what am I trying to say? Well, that markets that are decentralized by nature, there will always be markets where being precise it's more difficult, especially if you use small time frames. If you were to tell me that you trade the weekly time frame, the daily time frame, the monthly time frame, so then no matter which broker you use is about the same. But if you are doing trades with the 8-minute time frame, the 21, the 55, you will always have variability between brokers, and therefore the range timeframes will, as I said a few times, provide a benefit, but it's not going to be like it's going to be the day and the night. Okay, so that's why I said not using them, it's not a crazy thing, it's okay. And using them does provide a benefit, but it's even difficult to quantify because, again, it's a decentralized market, and sometimes different brokers will have different values and different UFOs, as you can see. Okay. Okay, so Roy, hopefully this clarifies your question. And I have a question here from Mark. If only one had TradingView Pro, is there a way to set up templates for each pair of time frame? For each pair of time frame? Yeah. Um, I mean, I'm not sure I'm following you, Mark. I guess that you want to do something similar to what I am doing, right? So the answer is yes. Okay. If you have a pro account, you can come to this button here. Okay. You can come to this button, select layout. You click to this button, and then you can select you want 2 charts at a time, 3 charts at a time, what position, 4 charts at a time, 5, 6, up to 8. Now, there is a limitation. I don't remember by heart. So let me show you that. tradewithufos.com/tradingview. That's the shortcut. Okay. tradewithufos.com/tradingview. This brings you exactly to the TradingView website in the place where you can see the differences between plans. So if I look at the Pro, I use the Premium, okay? But if you use the Pro, so charts per tab, you can have 2 maximum, okay? Me being Premium, I can have 8 maximum. So you being Pro or Pro Plus, I'm not sure what is your plan, Mark. You can have 2 or 4 charts at a time. So you would just come to your chart here, and instead of having 8 options available like I do, you should have either 2 or 4, depending on the plan you have, okay? And since you need 2 time frames per trade, so I would say that's good enough, and you're good to go. Got it. Yeah, so you just answered on the chat box. Got it. I hear you. Hey, Ricky, a pleasure to have you with us. Wonderful to know that you're working with Duyan. Send my regards to Duyan, by the way, when you talk to him. Cool. Okay. So, everybody, let's change subject. Second part of the session today. Okay. I'm going to use a TradeStation here. I'm going to use not only TradeStation, I will also be using OptionStation Pro. And also, apart from OptionStation Pro and TradeStation, I will also be using a free website, which is finviz.com. And hopefully, we will not be bothered too much by ads, okay? Because I could, in a normal case, do what I'm about to do with finviz.com with TradeStation, but I kept getting a corrupted error message when running my scanner. And I believe the reason why I've been looking into the symbols that were failing, because I deleted my cache folder and started again. And I kept getting the error message all the time, even with a fresh cache folder. So I've been looking at the symbols, and it seems that some companies that have not been updated on the scanning tools of TradeStation are companies that probably went bankrupt in recent times with the whole crash. And TradeStation tries to access the data, doesn't get any data, and then that returns an error message on the cache folder, like a corrupted message. So therefore, instead, probably TradeStation is working on that. Their integrity team, data integrity team, is working on that over the weekend. So soon things will be okay. But in the meantime, I needed a tool to be able to screen the market, to look for stocks that you may want to use for long-term investment. Okay, and that's the plan today. Looking at stocks that you may want to use for long-term investment, stocks or ETFs, and how to be very smart at it, because the beauty, okay, and again, maybe not the right word depending on what you are invested in, because let's say you have a 401k, so you would certainly not appreciate me talking about the beauty when you look at what happened to the market since a few weeks ago, isn't it? Because the market just really crashed very hard, even though we got almost a 10% back up on the last trading day. Still, we are very, very low from the peak that took place, in February 19. Okay, so if you measure from the top all the way to the bottom there, okay, we are talking about a pretty massive drop. Okay, a pretty massive drop. I'm just gonna measure these with percentages. Okay, and the size of the drop here is 26% down in 21 days. So it's a pretty massive drop. And certainly, if you are invested in a product such as a 401k, a mutual fund, or you are long stocks or something like that, this is really, really, really painful. This is not looking good at all. The other thing that is not looking good when you look at things such as the weekly time frame, for example. Let me see, where is my mouse? I lost my mouse. Okay, here we go. I got my cursor back. So the other thing that is problematic is that you look at the climate, and the climate is confirmed to be red. So that is problematic too, because it may mean that it's going to continue going down. You can see price on the last trading session just rallied just to get to a red UFO, where from there theory or a classical price movement would suggest this is going to continue falling down. So we are in a pretty bad market environment to be buying stocks from a climate point of view. But from a pure price point of view, if the S&P has fell by 26%, you may end up finding stocks out there that have been dropping by even more. And let's say you find stocks that are of a good quality, fundamentally speaking, and those stocks have dropped by, let's say 30%, 40%. Well, maybe buying those stocks, okay, especially if those stocks pay good dividends or give you other benefits, okay, for the long term. So maybe that could be seen as a valid choice, a valid action, okay. And I would not say that's a crazy thing to be done, even though doing it by simply going ahead and buying shares, then I would say that at that moment in time, you are taking excessive risk, because you are taking full exposure. When you buy shares, you own them, so you are fully exposed, right? So you are taking full exposure, okay, on those stocks. Okay, and by the way, do you guys see my TradeStation, or do you guys see a different screen? Can you please comment on the chat box, guys? Because I'm concerned that maybe my screen got is not refreshing. You see transition. Okay, good, perfect, nice. Royce, do you have to buy the UFO indicator for TradeStation and TradingView separate, right? Yes. Yes, they are delivered by different app stores and everything else. Okay, you thank you so much for confirming the TradeStation thing, guys. Okay, yeah, quick visual for all of you to understand this easily. So if I show you our website, tradewithufos.com/join. Okay, I think you will see that it's very very visual when it comes to understanding the apps available. Okay, so you have the apps for trading. Oh, you know what? I believe I just closed the website. So you have the apps available for TradingView. Here we go. So you have the apps available for TradingView. You have it right here. Okay, those, as you can see, you can agree and join. So you can subscribe from our website, and we deliver those apps ourselves. So we have a team that will activate those apps for TradingView for you. That's it. But then when it comes to the TradeStation apps, okay, this sends you to a different link, okay, which is the TradeStation App Store. So when you click, okay, this, you are being sent to a totally different environment, different than our website, and even the charges are not charged by our website via a credit card or PayPal or anything like that. This is charged directly via TradeStation. It's the payments are basically falling into your trading accounts themselves. Okay, so it's a totally different method, and therefore the activation and the subscription is totally separate. Okay. Good. But anyway, coming back to what I'm saying, so the fact that the market fell so hard is giving us opportunities to acquire stocks that, from a purely price point of view, went very, very low. That's nice because you can buy low. In everything we do in life, we should buy low, sell high. So that's great. But the problem is that the climate is in a very bad situation. Right? The climate it's very problematic because the climate suggests that the market should be falling at least one more week, right? So we got two candles out of 205. Remember, we always run these to up, so that would be three. So 2 out of 3 means the market should be falling for another week. Okay, and actually, if I look at the monthly time frame, okay, where are we at in the monthly time frame of the S&P? Well, actually, in the monthly time frame, if it doesn't reverse in 1 week, what statistics suggest is gonna be falling for 6 months. Okay, and it just started. So we may be in a market environment, okay, we don't have a crystal ball, it's all statistics, okay, but we are in a market environment where if the market continues, it's really going to be no joke, okay, and therefore buying stocks now just because they drop 30% or 40% or 50%, you may think, okay, I'm buying at a very low price point, that's great, but a low price point may become lower. Just like buying all times high, you buy high, but sometimes it becomes higher. So we always need to be a bit in the skeptical side as traders, and always have, let's say, a contingency plan, a smarter way to enter our trades compared to the average. Okay, and this is where options come into play. Okay, and therefore today what I would like to do is I would like to look for stock opportunities that are good long-term investments. But when it comes to planning that acquisition, instead of acquiring those stocks by just buying shares like everybody does, we're gonna put together an options play to help you heavily on how to creating an additional buffer that allows you to be wrong by a certain amount without getting into pain territory, and start profiting efficiently with that buffer in place. Okay. So that would be a smart thing to be done. Okay, so now because I got this problem with some of the symbols in translation, I believe some stocks went bankrupt recently with the crashes. So I'm using FinViz today as a little bit of an exception. I mean, the translation scanner is way more powerful, but hey, that's what we have today. And therefore, I would like to first point a little bit at what is it that I have input in the finviz.com website after clicking on screener. Okay, so I went here, I clicked on screener, and then you can see with the yellow color what I have done. I have selected stocks with a dividend yield of 4% or more, that's per year, Why? Because let's say I want to acquire a stock and the stock moves against me. Well, that's bad, but at least if the stock pays some dividends, that's giving me a little extra, a little, it's a little one, but it's a little extra advantage. On top of that, I'm going to put in place an options play that will give me a very wide advantage. So now I will have an advantage on top of an advantage, and it's all helping me. So when doing long-term investments, normally I would want dividend to be a nice one. Also, this is not always the case. And of course, if you're a professional economist, you will probably feel that what I'm about to say is oversimplified, and it is. But it's a simple way to think about it, and it's not that wrong. Which is when stocks pay high dividends, typically it means that fundamentally they are pretty okay. Uh, Stocks that pay high dividends are normally either stocks that are crazy risky, and those will not be in the list, as you will see later, or stocks that are quite stable for a long time. Maybe a food company, something like that. So those stocks will normally pay very nice dividends. Okay, so again, not always the case. I'm just giving you a bit generalities here, but somehow without doing fundamental analysis, by looking at high dividend yields, you are kind of doing fundamental analysis built in the fact that the dividend yield is a high value. Okay, so I would go for a high value because of what I just said, and on top of that, then if you're wrong on the trade, at least you get paid hefty dividends, which is not a miraculous solution, but certainly it helps. Okay, what else? Average volume, at least 300K. Okay, well, if a company is very risky, it's going to be a very small stock and they're not going to have such volume. So by looking at least 300,000 shares as an average daily volume, you are basically filtering out all those startup companies and so on. Then you want the price to be over 50. That's another filter that is going to get rid of many stocks that are risky. Okay, I mean, you never know. Okay, think about what happened to Lehman Brothers, and so they would not be considered risky one day, and next day they went bankrupt. So we never know. That's why we need to diversify. That's why when you invest, you need to use money you don't need. This is not trading; it's investing. So keep all everything that we discussed in the past in prior sessions, keep all of this in mind. Okay, and then also we want those stocks to be optionable, because what we want to do with those stocks is to run a specific option strategy. So if the stocks that you come up with are very good fundamentally, they're very liquid, all those things, but then you don't have options, then you cannot do what I'm about to show you. Okay, so this would be an initial version of the scanner. And if you were to do that, basically the scanner returns 56. Okay, the scanner returns 56 stocks that meet that criteria. Okay, 56 stocks that meet that criteria. Okay, so because I want to be a bit pickier, okay, so what I'm going to do is, okay, what if the yield, what if I go for over 5%? Okay? How many stocks am I going to have if I do that? Okay, and now it becomes 27. Okay, so 27. Okay, and by the way, I got stocks from Singapore here. So let's go ahead and focus on the USA, since we're going to apply this to the US markets. Okay, so if we do this, basically we end up with 20 stocks, and what I'm going to do is to go ahead and sort the stocks based on their price. Okay, and therefore I just need to click on the column and that will sort it for me automatically. And the first one on the list is IBM. Okay, so I'm going to start with the highest price point stocks. Okay, because higher price point stocks, okay, also imply normally an easier time when dealing with options, especially when we use options that are far out, because the higher the price of the stock, the higher the value for the option. Okay, and therefore IBM could be a good place where to start. Okay, so I'm just gonna go down the list one stock at a time. Okay, and we're gonna do this now with TrustStation. I'm just using FinViz as a screener since I got an issue with TrustStation earlier. Okay, now what else am I doing here? Well, I am looking at IBM. Okay, but what I'm also looking at is I'm looking at the climate, and I'm going to be looking at the UFOs and everything else. Okay, I'm going to be looking at this trade like I'm planning the trade like I would normally plan the trade. Okay, now what do we have with IBM? Well, with IBM I got a red climate in the weekly time frame. What about the monthly time frame? In the monthly time frame, IBM is also red. So in other words, if I didn't have any choice at all in the whole market, then I would go for IBM. because it pays over 5% dividend yields and everything else. But because I got more stocks, I got 27, I would rather keep going down the list, okay, to see if I can find something better. Okay, and the next one would be Cracker Barrel. So that's going to be CBRL. CBRL. I'm not sure about the liquidity for options on that stock. We'll see that later. But let's first work on the technicals, okay? Where you can see on the weekly time frame, I got two dots of red, and in the monthly time frame, I also have multiple dots of red. So yeah, not the best stock to invest in, okay? Then we got here an ETF, so I'm gonna pass on this one. And then we got Simon Property Group, SPG. So let's go for SPG and let's see what happens, okay? SPG. So SPG in the monthly time frame is red, okay? And in the weekly time frame, it's gonna be red too, okay? And therefore not ideal. Even though, like, if I only had those three candidates, right? IBM, Cracker Barrel, and SPG, well, I would be okay with this one because fundamentally it's supposed to be okay, and the climate is probably very exhausted, 7 out of 5. So this could keep going lower, but it should at least bounce by a little bit, okay? And the strategy we're gonna put in place probably with pay nice this way. So SPG, okay, I'm just gonna make a note for myself here. SPG, if I find nothing, I'll get back to SPG to use that one. But let's continue. This is an ETF. Then we got ABBV, okay, ABBV. So that's healthcare. So let's take a look at ABBV. And let's see what we have. So now in the weekly time frame, we got a blue dot, okay, which is not clear. Okay, it's unconfirmed. Okay, in the monthly time frame, okay, we got blue, okay, even though we got 6 out of 5, okay. So this climate is now reaching exhaustion, okay. So, but again, better than beginning of the red, like the majority of stocks we saw before. So SPG and ABBV up to now will be the stocks that I would be keen to check to see if the strategy will work with them or not. Chevron, okay, CVX, okay. So let's take a look at CVX. So what's going to happen to CVX? So CVX in the monthly time frame is red, and in the weekly time frame, well, no need to check, to be honest. We all know what happened to oil, isn't it? So crazy red. So again, that's another one, 9 out of 4. That would be another stock similar to to SPG, where it was so red that it may turn, right? Philip Morris, PM. Okay. So PM, Philip Morris, let's see. Ideally, you would find on the monthly or the weekly time frame some blue in the climate. That would make the trade to be more healthier. So in the weekly time frame here, we got some blue, even though it's unconfirmed, thin dot. In the monthly time frame, we got a unconfirmed climate too, 5 out of 5. So it's a bit tired, but Philip Morris, like we saw with ABBV, it's not the worst in the list, okay, even though it's not ideal. So we keep looking, okay, WPC, okay, WPC, and then win. So WPC, I just want to be equipped with a few symbols, okay? So monthly got one red dot, okay? Weekly got two red dots, okay? So no good. Win, that was the next one on the list. So what do we have with win? Plenty of red on the weekly, 7 out of 7. So it's not exaggerated yet. So it's probably going to continue falling. And the monthly just started falling. So it may fall for another 6 months. So yeah, based on stats. So IIPR and MED. Okay, so IIPR and MED. I'm going to look at these two. And, I already got 4 symbols in my list. So I'll go for that if any. Okay, so in this one we got a confirmed blue, okay, confirm blue. And then we got in the weekly time frame, it's blue, but it's 9 out of 8, so it's a bit exhausted, okay. But again, I will say that IIPR, I'm going to put it together with Philip Morris and ABBV, okay. Kind of like not ideal, but showing a little bit of blue. And the last one I said was med, and I'll stop here. Okay, so med. So MED, and here we got plenty of red on the weekly, but not that much, so it's likely going to continue. And in the monthly time frame, what do we have? Monthly time frame, we got 10 out of 4. So actually, it's not too bad, really. I'm going to put it in the group of SPG, CVX, and MED, because it's fell so much for so long that if it reverses, it's probably going to be the beginning of a brand new climate in the opposite direction. It's been falling for too long. Okay, based on stats, it's not sustainable. Okay. Good. So anyway, so I came up with 6 symbols, okay? And I'm just going to type it on the screen so you know what I have on my end. So I got showing a little bit of blue, ABBV, Philip Morris, and IPR. Those were showing a little bit of blue and showing lots of red, and therefore they've been crushed so much that it's kind of like they may react to the pain by bouncing, okay? And bouncing is an opportunity for us, okay? So that's SPG, CVX, and MED. Okay, those are the 6 symbols I got with me out of this little analysis of finviz.com, okay? Now, by keeping all those symbols in mind, okay, I'm gonna start with SPG, for example, just to pick one. And now what I'm going to do is I'm going to be working on the stock chart. I'm going to bring the option chain, and I'm going to start putting together an options play, which hopefully works. And if not, we'll go to the next stock, and you will understand how we can take advantage of these very incredible situations, And it doesn't need to be a market crash like what's happening now with a worldwide pandemic, with a coronavirus and everything else. But it could simply be one stock that you hear on the news. Like, for example, I remember like 2 years ago, Volkswagen, when they were caught lying when it comes to the emissions, okay, how much the pollution their engines would make, the reality versus the theory, and the stock was dropping, like I think it was, if I remember correctly, like 35% in one day. So the same thing could happen. Okay, it doesn't need to be today, and hopefully this lesson would be powerful for you guys. Okay, so what do we do then? Okay, well, we have this massive crash, right? And it's so red that this opens the door for us to look into acquiring that stock at a very low price. Okay, what do we need to be able to acquire that stock at a very low price? Well, in theory, if you use the monthly time frame like I have here, okay, here I would need to use the 377-minute time frame. Okay, this is the normal set of time frames that we have, that you have seen earlier, that I'm bringing back to the screen right now. Monthly is 377. That's a normal set of time frames, but that is when you are trend following. You trade in the direction of the climate. Okay, right now we are not trading in the direction of the climate, so really I cannot rely on 377-minute time frame because they mean nothing in that particular scenario. What I want to do is I want to go to the monthly time frame, the same time frame that I am observing here on the left, okay? And as a second choice, I would also be okay to look at the weekly, okay? But I would not go below monthly and weekly for this type of exercise, because you are planning on acquiring a stock for a very long-term move. So if you were to look at the daily, the 4-hour time frame, again, I'm not going to say it's wrong, but certainly you will expose yourself probably for a bounce and that's it. And then a bounce and that's it, maybe a nice profit, but then you never had the chance to collect dividends, which are paid every 3 months' time. You would never be holding that stock for the long term, which was the initial idea behind what I'm discussing today. So make sure you don't switch between I was an investor 10 minutes ago, now I'm trading. You know what I mean? Stay in investor mode all the time. And therefore, in this sense, If you were to trade in the direction of the climate, then yes, use the 377-minute time frame. But if you are not trading in the direction of the climate, you need a wider wall to stop the bleeding in this case, and have a bounce happen. You need a very strong floor. Okay, so we're gonna be using monthly and weeklies for that application. Okay, so what do we have here? Well, we have a place where acquiring the stock would make sense, and that is 44.37. Okay, 44.37 is the top of that UFO, and that particular stock is currently trading at 90, so it's half the price. Okay, that would mean another 50% drop. So really, options are very inflated, but I think that, so let's say I go out 90 days and I look at the 45. Notice that the puts, I'm going to be using puts in this application, as you will see, pay me only 1 cent. So I get paid nothing. And the reason why is because, we're talking about 50% drop. Okay. And 50% drop, that is a lot. Okay. So because of that, okay, I'm going to take a look at how does the weekly time frame look like. So instead of monthly, I will move to the weekly and see how is that looking like. Okay? And in the weekly time frame, I may need to load more data. We do have a UFO right there. So let's load 20 years of data. We do have a UFO right there, but what I like the most here, that is very exciting to see, is that if this UFO fell, I have another one. And if that one fell, I have another one, and another one, and another one, and another one. So, hey, could all those orders be canceled? Absolutely, especially if the market continues going down and the world is in complete fear. Certainly, okay? But at the same time, it's so many UFOs. If all of them were to be canceled, wow, it would be such a thing, right? And on top of that, probability for that stock is pretty nice, 57%, which is not common to have such a great value in a stock, as you have seen before. Futures and forex and commodities that trade many hours a day, yes, you get easy 60 plus, sometimes 70 plus. But with stocks, the moment you get above 50, we are happy already, isn't it? So 57 is actually close to 60, which looks pretty good. So technically speaking, that's looking good. Therefore, what I'm going to do is I'm going to look at that first UFO, which is located at 80, isn't it? So 80.12, that's the top of the UFO, so 80. And I'm going to be planning here, I'm going to be planning on this trade. Okay, one part of the plan, let me make some space because I'm going to have to type. So one part of my plan will be to sell the 80 put. Okay. Now, there is more to this. I need to explain this properly. Let me also add space on the right, so I can move my text, and that way you guys have a good visual. Okay. So selling the 80 put, okay, for the ones of you that trade options, you 100% understand what that means. For the ones of you that are not trading options, selling the put means that by selling, you're going to get paid. And in exchange for being paid some premium, we're going to check how much in a second. So in exchange for being paid some premium, you are accepting to get the stock put to you at 80. Okay. In other words, if that market falls, you will find yourself long shares of SPG at $80 per share. That's what that means. Okay, that's what that means. So I'm selling an options contract that obliges me to buy at 80. I am going to get the stock put to me at 80, and I get paid some money to do so. That's what that means. Okay, so let's take a look. First, I'm looking at the option chain. I want to look at premium levels: 57, 55, 50, 54, 55, 53, 59, 52, 55, and from there it drops very heavily to 46. Okay, so after 61 days, okay, I can see how the levels of premium drop pretty intensively. This one here seems to be the one with 36 days, seems to be the one that carries the greatest amount of premium. This is called implied volatility, and it reflects how overpriced the value of the options are. Okay, so I want to sell options, and therefore I want them to be overpriced. So I'm looking at 59 as a potential good starting point. Oh, wait a minute. This is the SM. This has not uploaded. Let me do that again. I'll take a sip of water if that's okay, guys. Okay, so just waiting for this to load. It's not loading. So definitely something going on with TraceStation. I'm not sure what it is, but I'm just gonna restart OptionStation Pro. Hopefully it will work, and if not, I'll have a backup plan here in a second, and we'll make this work. Okay. Yes, Mark, I just see your message now. My option chain didn't update. Okay, let's see. So, okay, now it did. Perfect. Thank you, TraceStation. So what do we have? Okay. Well, actually, it didn't. It didn't. Still SPG. Yeah, so you can see the message here. Timing out, waiting on the first sequence after 15,000 milliseconds. Okay, so we're having a problem here. You can also see it here with a red X. Something's going on. Maybe it's weekend maintenance with all the craziness that happened in the market. Maybe that's the reason. Okay, so I'm just gonna bring a different platform. So we can do our analysis. One second, everybody. I'm just working on another screen. Okay, it's gonna be darker to see. It's not gonna be as pretty, but I'm sure that many of you have seen before. Thinkorswim, which is the platform I just loaded. Okay, so I got SPG here. In this case, it did load well. Okay, my fonts here are quite small actually, so I'll do my best to zoom in and everything else. Okay, but anyway, so we have here levels of volatility, which is 126, 90, 81, and then it drops to 64, 58. Okay, so big drop between 81 to 64. So I would ideally want to use 81, which is 61 days to go, which is May expiration. Okay, so I would like to use that one. Okay, and we're looking at this one, and I look at the 80 strike. This one pays me $6.45. So again, I know this is very, very small. I know this is really, really small. Okay, so 80 strike right there, 6.45 cents. That's the value that you will receive by selling that option. Okay. Now, some people out there will just sell that option and that's it. Okay, and if it drops, it's put to you at 80 and you keep 640. If it goes up, then it's not put to you, but you made 640. Okay, and some people will think about it from this angle. Okay, and again, I want to show you how it makes sense, but also how it doesn't make sense. So some people will be like, okay, so if I buy at 80, but I get paid 645 to buy at 80, is like I bought at 73.55. That's a great discount, and I'll take it. And you know what? It's a point. Some people will think about it from this point of view. They will be like, okay, I'm gonna make 6.45. Okay, this is for me to make 645. I would need to commit $80. Okay, so I'm making 6.45 out of $80. Okay, and I would make this okay in 360. If I annualize it, that would be 365 divided by 61, which is the time to expiration. So if I annualize that, you would say that's a 48.2% return in a year. And some people will be very happy to sell the 80 put because of those reasons. Because if the stock is put to you, You basically bought it at 73.5, and some people are going to be happy with that. If it's not put to you and it goes up and the put expires, then in 61 days, you made $645, which is an annualized rate of return of 48%. And many people will be like, that's amazing. Okay, well, to me, it's not. And the reason why is because if it falls and it's put to you and it keeps falling, you could actually lose much more than that, right? And as an investor, we always need to be prudent, okay? And therefore, what I would like to do, okay, instead of going ahead and just doing this trade, selling the 80 put, and that's it, what I would like to do is I would like to do a combination where, yes, we want to sell the put, but in case, okay, in case the market keeps going lower, then I want to buy a put below. For example, let's say the 75 put. I don't know. I still need to check what's going to happen with that, but let's see if that's going to be valid. Okay. So if I was to sell the 80 put and then buy the 75 put, okay, well, if the stock goes down to 80 and is put to me, and then it keeps falling and falling and falling and falling and never came back and it goes to zero, you know what? I was obliged to buy at 80, but I have an insurance policy that allows me to sell at 75. So even though the stock went to zero, okay, I have the right to sell at 75. In other words, what's the most you can lose? Okay, well, your maximum risk is to lose $5 per share. Okay, so now I have my risk under control. Now, for me to have my risk under control, I need to pay, buy means pay, I need to pay to buy the 75. So the net credit I will collect will not be 6.45. I will sell the 80 put for 6.45, and then I will have to pay something in exchange. So my net credit is going to be lesser than that. Okay. How much? Well, let's go back to Thinkorswim and put it together. So I'm going to do what we call a vertical spread. Okay. And I'm just going to click on analyze a vertical spread. Here we have it in the bottom part, okay? By default, I clicked anywhere, so really that was not well done by me. So I'm just gonna adjust this to be 75 on the bottom part and 80 on the top part. I'm about to zoom in as well, so you guys get to see that much better, okay? So I am zooming in right now. So I am buying +1, the 75 put that expires in May, okay? And I am selling -1, the 80 put that expires in May. What is the net credit I would collect if I do that? 2.90. Okay, and this is going for the midpoint between the bid and the ask, which in the real world, this is not a very, very liquid stock. So you may get a little less than that. It depends on your ability, on how you execute. It depends on the broker, on how good they are routing orders. But, for this exercise, I'll just pretend 290 is going to be the credit I collect. Okay. And of course, during real market conditions, you will need to take a look at real-time figures and liquidity as well. Okay. So you're going to take 290. Okay. So notice that instead of 645 we saw before, now it's going to be 290. Okay, but now what's the most you can lose? Okay, what's the most you can lose? Well, if I bring a calculator, so now I'm going to make 290, but the most you can lose is 500. Okay, 5 times 100. The difference between 80 and 75 is 5 times 100 is 500. So, by the way, really, the most I can lose is better than that, because the most I can lose is 5, but for me to lose 5, I get paid 290. So the most I can lose is 210. So in this trade, it's either you make 290 or you lose 210, right? In other words, for you to make 290, you have to risk 210, okay, which is an annualized rate of return, okay? It's a 61-day trade, but annualized, it would be an annualized rate of return of 826%, which is way better than 48%. And on top of that, if the market crashes and goes to zero, the most you can lose is 5 minus 290, which is $210. So you have mitigated the risk very much. That's great. Now, the problem is the most you can make is 290. Okay, this is for you options traders. You know that this is called a bull put spread. Okay, bull put spread, or also credit spreads, which is a strategy where you sell the options, you wait until they expire, and if they expire, then you keep the premium. That's it. And therefore, you make 290 days in 61 days, which is a great rate of return, but at the same time, is the most you will make. And in this case, we don't want that. Actually, we want to be exposed to owning the stock. That's number one. And second, if we are not going to own the stock, but the stock ends up moving intensively to the upside because that climate is so crazy stretched, then we want to profit from the move. And in this case, you may have the move and this thing goes up to make all times high again. And guess what? The most you will make is 290. Okay. So the bull put spread, it's nice, but it has limitations that for this type of application makes it a bit inefficient. So why would I suggest to do? Well, what I would suggest to do is the following. What I would suggest to do is to take two of those bull put spreads. Why two? Well, because if I take two, the $290 I'm going to be double, which is 580. Okay. You may say, wait a minute, you also have double the risk. Yes, that's for sure. Okay. But instead of shooting to make 580, what I would like to do now is I would like to spend 580 buying a call. So I would like to buy a call that costs around 580. Why? Because then I can do this trade for free. Okay? I get paid 580, I spend 580, I make no money. And now two things may happen. If it goes up, I profit because the puts will make me 580 and the call will pay me. And if it goes down, I get the stock put to me, which is what I want, at the price where the UFOs are, which is what I want, and I start collecting some dividend. And if the world is ending and it wants to crash all the way, then the most I can lose, it's 2 times 210, which is $420. So that would be a pretty smart approach on how to invest, because basically if it goes up from now, you profit immediately. Okay? But for it to be put to you, it has to drop another $9, which is, let's call it 10%. It's over 10%. So it's like the stock drops another 10%, and now you buy it 10% cheaper where the UFOs are, and now you start collecting dividends, knowing that you have this protection that in that particular scenario, the most you can lose is, as I said before, 420, which is 210 twice. Okay, so makes sense. So now the question is, which call can I buy with 580? Okay, which call can I buy with 580? So if I go back to single and I look at 580s, okay, I could buy the 105 would cost me, anywhere between 560 and 335. So if I was to pick this one, okay, and by the way, let me do this in this manner. I'm just gonna analyze and buy where are you, my friend? Double the unbalanced. Here we go. Butterfly. I was looking for the butterfly. So I don't want to use a butterfly, but I just wanted to have 3 rows. Okay, I'm going to make this custom. So I'm going to buy on the top a call. I'm going to sell in the bottom 2 puts and buy in the bottom 2 puts. So if you think about what we said, the very bottom one is going to be the 75 put. The one on the top is going to be the 80 put. Okay. And the call I just said that could be a good buy will be the 105. The 105 call, let me zoom in. The 105 call would cost you 560. Selling 2 of the bull put spread would pay you 580. So certainly you have money to spend on this call and pay 560. Actually, you're going to have a little bit of a credit. Okay, using the midpoints, the credit Okay, here on the bottom part of the screen, the credit is 1.5. Okay, so actually you could do this for a credit. Okay, earlier they said you do it for free. Well, it's better than for free. You do it for a credit. Okay, and if you look at the risk profile graph, you would understand well what's going to happen. Let me see what's happening here. This is not right. This is not plotting properly. This is not correct. And I see all the Greeks are 0. So I don't know if this is because, again, there is some sort of a maintenance going on right now as we speak. This is certainly not normal. This should not be like that at all. This should not be like that at all. Okay, so let's do this. I'm gonna move this up to make a bit of space. I'm gonna disable it. And I'm just gonna insert it the way I did before. So right click, actually, let's sell, buy, sell, buy. So you will see in a second what I want to do here, okay? So I got 4 units here in the bottom part. Please don't be confused. I'm going to explain that clearly in a second. So you will see how everything makes sense. So if I buy the 75 and I sell the 80, okay, buy the 75, sell the 80. Okay, so please focus on the 2 in the bottom for now. Okay, so the difference between those two, okay, 830 and 645, how much is that? 830 minus yeah, well, that's not the midpoint. That is not the midpoint. Okay, well, forget about the cost. Okay, yeah, this is so much easier to put together with TradeStation, but it's okay. So anyway, so we have, let me zoom in again and explain that to you all. So what are we doing? Let's focus first on the bottom part, the very, very bottom part. So the very bottom part is a portion of the trade where I am selling the 80 put and buying the 75 put below using May expiration, which is 61 days, minus 1, plus 1. Okay. Now, this would pay me, as we said earlier, 2.90. Okay. But what am I going to do? I'm going to make it double. So sell 2 and buy 2. If I sell 2 and buy 2, okay, so this is going to pay me, okay, sell 2 and buy 2. You see the minus 2 and the plus 2 with the puts. So this is going to pay me double, which is 5.8. So with 5.8, I can go ahead and buy a call. And the call I said I would buy, okay, the call I said I would buy is the 105. So I am buying one of the 105 call because that one will cost me 560 and I got 580 to spend to buy 560. Okay. If you did it all together, which is what I have here on the top, okay, if you did it all together, which is what I have on the top, okay, the theoretical credit would be 1.5. Okay, when you execute this in the real world, you may get $1 of credit, okay, something like that. But anyway, it's better than free because you get paid enough on the puts that justifies the purchase of the 105 call. Okay, so that is what I have here on the bottom: 105, 80, 75, call on the top, put and put in the bottom. Okay, now let me activate the 3 guys in the bottom so we can look at the risk profile. Yes, I'm having problems with Thinkorswim here, guys. Yeah, I'm having a problem with Thinkorswim. So let me do this. There is a setting somewhere. for me to use the midpoint by default. Give me 1 second, guys. If I find it, it's gonna make our life so much easier. Just give me 1 second. Calculations. Display, startup system, positions, orders, account, notifications, order default, hotkeys, my profile. I don't remember where it is, guys. Okay, maybe some of you are using Thinkorswim. I use Thinkorswim for execution only, not for simulation. So I don't fully remember where it is at the moment. Yeah, we need to do a lot of research. So I'm just gonna pass on this. Okay. Anyway, I will explain it on the chart, and that's it. Okay. So basically, by buying the 105 call, okay, that costs 560, together by selling two, okay, two of the bull put spread using the 80 and the 75, you end up with a trade where the cost of this trade is basically a small credit, okay? And now what happens is that if the market goes up, that call is going to pay you immediately. The puts are going to pay you immediately as well because they lose value as the market goes up. And therefore you start profiting like you own the stock, but you don't, starting at the current price, okay? If the stock goes down, okay, then that option will expire, okay? But that one will get you a sign. So now you own the stock at 80, okay? So now you own the stock at 80, you start being paid dividends, you are in the UFOs, and hopefully it will move your way. And if not, you can use a stop or something like that. If before May, before the 61 days from now until expiration, that stock was just to collapse so much that it's going to be down here at 40 or something like that, so then the 80 put will get you a sign, but the 75 put will get you exercised. So you would be in at 80 out of a 75, and therefore you would lose twice the risk of the trade minus the credit collected. We saw that the credit collected was going to be 580, right? We saw that the payment for the call was going to be 560 at market price. The midpoint was, I don't remember, but we were going to have a net credit. Okay, net credit was minus 1.5. So what does that mean? It means that the most you can lose is 5, the distance between the strikes, okay, minus 1.5. So how much is 5 minus 1.5? Well, it's 350. So what is the maximum risk of the trade? Assuming you get filled at $1.5 of credit, okay? So max risk equal $350 if you use 2 puts with 1 call. You can certainly go for 4 puts and 2 calls, or 6 puts and 3 calls, or 8 puts and 4 calls, and so on. And therefore, the risk multiplies times 2, times 3, times 4, and so on. Isn't it? But if you were to do it one time, the way I have it here, the risk is 350. And if the stock begins moving up, you start profiting immediately. And this is a pretty smart way on how to approach ownership of stocks. Okay, even though I am having a difficult time to plot it properly here, and I'm not fully understanding the reason why. It probably has to do with maintenance over the weekend or something, because this should be plotted very easily. It should have Greeks instead of everything is 0. So yeah, all the Greeks are NA, NA, NA. That's the problem. Everything is NA. So I don't know why, okay? But this is gonna be a positive delta position, okay? For you options traders out there, you know, when you do a bull put spread, it's positive delta. And for you options traders out there, when you buy a call, is also a positive delta. So if you do the bull put spread together with buying a call, it's positive delta plus delta. So it's positive delta. In other words, if the stock moves up right now, you start profiting right now. And if it falls, you get the stock put to you at 80, which is your intention as a long-term investor willing to acquire some shares of a stock that pays dividends nicely. Okay, my friends, how is it going so far? You guys let me know, because we've been running for 1 hour and 15 minutes, I believe. So it will be Yes, Mark, you're absolutely correct. I made a mistake there. Yeah, let me rephrase it. You are absolutely correct. I wanted to show you the risk profile on Thinkorswim, which would have been more visual. You are correct. Let me correct that. Thanks for that, Mark. So the risk of the trade is $5, right? But you do it twice. So Mark is absolutely correct. The risk of the trade is $1,000, okay, minus the credit collected. Okay. So assuming the credit the credit is minus $1.5, okay, you have $10 of risk. Okay, risk is $10, okay, which is 5 times 2. Okay, the risk is $10 minus 1.5, and that is $850 of risk in this trade. Okay, so that is for one implementation of this combination: two puts, one call. If you double the whole thing, four puts, two calls. You triple the whole thing, six puts, three calls. Then this doubles, triple, and so on. Okay, but that is absolutely correct. And thanks for that correction, Mark. I didn't do the math correctly there, so thanks for that. Let me see. Yeah. So, guys, I will need a little bit of feedback from you at this moment in time. How is it going so far? Everybody good? Everybody good? If you're good, I'd like to do one more exercise and then I will let you go. Yeah. I'm just going to take 5 to 10 more minutes maximum. So a break would not make sense, Mark, even though you all deserve it. Okay. So if you have to take a break, feel free to take a break. I'll just do one more application and I will complete the session today. Okay, so we did SPG. That was a stock that was falling quite hard, isn't it? So the next one I wanted to check is ABBV, which was a stock that was showing a little bit of blue. Okay, it was showing a little bit of blue. Okay, in the monthly. Okay, and therefore, I would like to start, with the 377-minute time frame, because when the monthly is showing that, that means that you are trading in an uptrend, at least in the monthly time frame, right? So I'm just gonna wait for the pending data to go away. Okay, and unfortunately, this is a trade that I am about to discard because 38% would not be good enough. So I would now move to pre and post market. And let's see. Oh yeah, and with the pre and post market, we are talking about a much, much better parameter, 67%. The institutional interest for that stock is very, very high, and it's happening before and after the market is trading, not during market hours. Okay, so now we know this. We also see that 82 is the average. Okay, 82 is the average. Okay, current price is 84. But again, we are not gonna purchase the stock or do a directional options trade here. We're gonna do the same sort of application. So really, I don't mind too much on where my UFOs in this particular application. So what I'm going to do is look at the next UFO here on the list, which is located at 81.29. So 81.29 is $3 and a half below 84.70. The advantage is not as great, but I don't need that much of an advantage because the climate is a better climate. Okay, that's why now I'm using 377, and before I was using the monthly, and then I moved to the weekly. Okay, and I would not want to go below that. In this case, 377 is the way to go, and we're gonna be using the 80s. Okay, so back to Thinkorswim. I'm just gonna load ABBV. Hopefully the Greeks will load in this one, and oh yes, here we got Greeks. So I'm happy to see that. Okay, and the next thing I want to do is I want to take a look at the implied volatilities here. So we got 83, 51, 65, 62, 56, 54. So it seems that here or here, I would say that 65 is probably the ideal one. Okay, 65, 62, because then it drops very heavily to 56. So 65 or 62 would be the way to go, even though that's not a very liquid stock. So I'm going to use the monthly, which has 56, or actually no. Yeah, I'm gonna have to do that because yeah, already the monthly is not too liquid, 220 to 4. So yeah, I'm gonna have to go with the monthly. The weeklies are gonna be terrible for that stock. So we look at that, okay? And when looking at this, okay, I got 82 and a half, 80. I don't have 81. What if I look at the weeklies? The weeklies do give me 81. Liquidity is absolutely terrible, absolutely terrible. So I cannot do that. So I'm just gonna stick with a monthly expiration 33 days from now with 82 and a half and 80. Okay, and I'm gonna go for 80. Okay, so I'm gonna go for 80, analyze and sell a vertical, and I would like to consider and check what's gonna happen if I do 80 and 75. 80 and 75, and this is giving me a theoretical credit of 2.05. Okay, 2.05 is the credit I get, and therefore with such credit, okay, I will want to now go ahead and buy a call for that price, and that would be the 95. Okay, so I'm going to analyze and buy a single call. Oh, not that. Single call, which is the 95. Okay. So the 95 is going to cost me 190. The spread is going to pay me 205. So I can do this trade basically for free. Now I do believe I have the Greeks. Okay, you can see this trade, we have a delta of 32. Okay, so now the simulation is going to show normal. Here we go. Okay, so if the stock begins moving up, okay, I start profiting, 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 right? If the stock goes down, I start losing. But what's the most I can lose? There's no way I can lose more than the difference between strikes for the option, which is $5, the difference between 80 and 75. So very similar approach, but now it's nice because finally we can see the graph. Earlier, something was wrong with the Greeks on Think or Swim, probably just like TrustStation, they are doing weekend maintenance, okay? So anyway, let me put that on the chart, okay? So the way to approach these trades would be to sell the 80 put, buy the 75 put. Okay, by the way, notice that with my initial application, okay, given the premium I collected, there is a lot of premium in that stock, okay, and maybe I need to rectify that during market hours because liquidity seems to be quite wild in the option chain. We also know the option chain doesn't look as liquid when the market is closed compared to when the market is open, and this distorts the Greek too. So I'm not fully sure, but right now it seems that they could collect 2.05. I don't think that's possible actually, and it would cost me 190 to get this trade. And the reason why I say it doesn't look like possible to me is because when you look at the spreads, I mean the difference between the buying price and the selling price for the 80 option is 195 to 590. The spread is humongous. If you go in the middle, yeah, then it's gonna pay you what it says, but probably in the real world it's not gonna be that wide, and you know you will not get that price if it was that wide. So therefore, I'm just gonna do the same thing I did before, which is instead of selling only one of those options, I'm gonna sell two. Okay, so notice I just changed from +1 to -1 +1 to -2 +2. So I'm going to do two of the bull put spreads. Of course, now you would expect to collect $4. Okay, so you will be like, okay, I'm going to buy the 90. Okay, I would say that probably is not going to be possible either because of what I said about liquidity, but probably the 92 and a half, yes. Okay, probably the 92 and a half, yes. So this is to be revalidated during market hours, but basically this is going to be a trade with a starting point of 52 delta, which if the stock begins moving, that's going to start paying you very, very nicely because on top of that, this application is positive gamma, okay, which is something I didn't say, but it's positive gamma, meaning that if it goes against you, you lose at a slower pace. If it goes your way, you profit at a faster pace. So that's nice, okay? So in other words, 80, 75, and 92 and a half, this would be the application, okay? You would take two, okay, you would take two of the spread, okay, and then you would pick the 92 and a half, which is pretty far away, okay, 92 and a half. So buy 92 and a half call, which is pretty far away in the 377-minute time frame. Okay, but in the monthly time frame or the weekly time frame, that is more or less there. Is not that far. Plus, you are doing this because you want to purchase the stock and hold it for a long term, so it pays you dividends. Okay, so here the thing, the beauty, as I said before, is that if it starts moving up immediately, you start profiting immediately. Great. But ideally, what you would want to see is that the stock falls to 80, is put to you, and then it goes up, and you make money on the stock and the dividends. So that would be the ideal scenario, even though we don't know what's going to happen. And that way, now you're equipped with a tool where if it goes up immediately, you profit immediately. If it goes down immediately, you start losing it immediately. But if it crashes all the way, the most you can lose is the difference between strikes minus the credit collected. It's going to be similar to earlier. Okay. And if it drops by a fair amount and is put to you, and it doesn't drop below 75, okay, maybe fails in this UFO but bounces from the other UFO, well, now you are in a stock trade, and now the stock is appreciating, hopefully, and now you are being paid dividends in the meantime. Okay, so again, this is a smart investing application for market conditions which are quite extreme, like we are seeing as we speak. And certainly it's a smart approach in the sense of building yourself a buffer. Okay, but certainly I would recommend to be very cautious, calculating your risk properly, and certainly not to be greedy and using the bottom protective put, because if you were to do this by selling the 80 put without the protecting 75 put, yes, you get more premium, but you can get absolutely killed on this particular trade, and it would be in my mind very risky given the mindset of an investor. Okay. Anyway, everybody, I would need your confirmation that all is good. We are done with the session today. So if there is any question, I will take it. If there is no question, I would certainly appreciate that you say all good, or if it's not good, positive critique is also something I would appreciate. But basically, I would like to confirm that you guys follow the session and everybody is good with that. Yeah. So little feedback there from everyone, if possible. All good. Thank you so much, Leon. Okay. Mark, could one put a stop in for reducing the risk? Yes. Once you are put the stock, once you are put the stock, Mark, yes. Then you would use a stop on the stock. But I would not use a stop on the spread, because you're gonna get massive slippage, right? And in the end, it means that you didn't want to really give yourself the chance to acquire the stock. So if you don't want the stock, don't do this. This is for you to be 100% willing to acquire shares of that stock because they pay dividends, because you want to devote a percentage of your portfolio to own shares, etc., etc. If that's not the case, don't do it. Okay, and therefore it's okay to use stops only once you have acquired the shares. If not, you're basically gonna get in trouble out of fear, touch the trade, act in the middle of the trade and not let the trade to be what we have defined. On top of that, you're going to get major slippage. Ray, yes, thank you, Jose, very informative. Andrew, yes, all very good. Thanks. Charles, thank you, good. Roy, thanks, Jose. My pleasure, everybody. Super thank yous out there. And I would just like to conclude the session by, wishing you all to stay safe. There is a putting on the side what's going on in the marketplace, which is volatility that we have seen this before. There is something going on out there in the world that, at a human level, seems to be dangerous. So I'm in Asia. We've been looking at the coronavirus in the eyes for a few months now, and things are done pretty safely here in Asia, and things are pretty okay, even though we cannot be overconfident. But other parts of the world are suffering very badly right now. And I just want to throw out there, this little note. Don't mean to be dramatic or kind of overreacting to it, but yeah, definitely, I think we all need to be conscious and stay safe, and think of everyone else apart from thinking of us and our own families, because if we carry the virus with us, we can spread it to others, and that other person may be older, may not be strong, and we create trouble. So it's time to not to be selfish out there, and time to think of the group and the community before us, and be safe. And so anyway, again, I'm not a health expert, but certainly I wanted to say that because it's a concerning situation in some countries out there, and I am sensitive to that. Anyway, everybody, stay safe as well in the marketplace, and I will see you soon. Bye bye, everybody. Take care.